So today what I want to do is put you in a thought experiment of what if your government shutdown happened. Now, I don't know what your government shutdown might be. In this thought experiment, let's think it through. Let's say one of your banks called the primary line of credit used in your business. And so now every touch of income you were able to take from the business now has to go toward aggressively paying down that credit line so that they will make you bankable again. What's another one? Major vendor, like somebody that fulfills a great deal of what you need for your customers. Goes out of business, keeps your deposits, takes your money, and now you're left scrambling. By the way, for those of you not listening who are not business, or those of you who are listening, you're not listening. Those of you who are listening who are not business owners could have some difficulty relating to this, but these are all things that person whose name is on the door, whose signature is on the lease or on the mortgage of that building, they're dealing with these things all the time. You have a major employee that does a great deal of business development for your company, leave, go work for the competitor. You see, all those things are things that we are prone to every single day. So what would be some basic tenets that we should have in place in our finances? And I'm going to go to the super basic tenets, even those tenets that are espoused by financial entertainers that we otherwise don't fully agree with. And we've even debunked some of their math here on the podcast. But let's just talk about those first steps of what you should be doing financially to put your financial house in order. Well, one of the first is to make sure that we minimally have 3 months of expenses in the bank. Let's think about that for a moment. Now, it doesn't need to be 3 months of your income right away. It just needs to be 3 months of your expenses. So if your expenses are $15,000 a month, that's $45,000 that should be set aside. If your expenses are $20,000 a month, it's $60,000. If it's $10,000, it's $30,000, and so on. And what I would have you do is have your real expenses, your real spending for the last 3 months, not your bare bones expenses for 3 months. Like if you had to cut at the bone and recover all that, this should be your real spending for the last 3 months should be in cash. The next thing you should have in place is over time, build up to 1 year of liquidity. Now, 1 year of liquidity would be 1 year of your expenses, 3 months at that level. That's just like you're living right now. And then the other 9 months, that can be income that's set aside with your bare bones budget if you needed to. Now, here's why. Certainly, if you had 3 months to adjust, you could sell a car, you could, you couldn't downsize a home that quick. But you could say, okay, we're not going out to meals anymore. We're canceling the vacation that we were going to go on, et cetera, if it really got dire and you needed to hold on for an entire year. What else would you have to have done? Well, the simple things around your protection. We've talked about this nearly to exhaustion on the podcast, but the reason we keep bringing it up is you're never going to hear it from the traditional financial media. The traditional financial media doesn't want to go through and revisit that you should have your car insurance, homeowners, wills and trusts, all that stuff squared away, that you should have the appropriate amount of disability insurance, life insurance, and you should, because by the way, one of those things, being unable to work due to sickness or injury, a death of the primary breadwinner, the death of the non-primary breadwinner, the person that's the CEO of your household, could greatly impact household cash flows and act as your government shutdown. You see, what we have to do is protect ourselves across the board. So that moat needs to be dug. We have plenty of podcasts on that, from everything from life insurance to protection. If you're having trouble finding those, email us at info@sfgwa.com. So you've got at least short-term cash, 1 year of cash. You should have a midterm bucket. If you've not heard any of the bucket conversations, just go to wherever you listen to podcasts, go to our podcast, type in buckets. It will come up. That buckets podcast will talk about the importance of a midterm bucket. Most people, what they do is they fund short-term bucket, then they fund long-term bucket, and that's it. And they have these two polar opposites. Like, I need some money in case of an emergency right now, and then I also need some money when I'm old. And that's one of the biggest breakdowns people have, because there's lots of reasons why you might need capital more than just a year's living expenses. between now and age 65. And we go into that deeper. So far we have 3 months liquidity to start, 1 year liquidity of more cut back expenses. Then we also need to be in a position that we have some midterm bucket money with a moat dug. So those are our kind of first 4 steps covering our bases for the basics. And now let's think about what happens to a household in a government shutdown or whatever your government shutdown might be.
This is a clip to our weekly podcast, so if you like this content, hit subscribe, hit the notification bell, and go over to your favorite podcast app and subscribe to Sound Financial Bites so you can get our full weekly show. And as always, if our philosophy resonates with you and you want to chat with me or one of our advisors about our philosophy, see if it applies to you and your family, just follow the instructions in the description below.